Hey folks, Lee Smith, Spouses Buying Houses. Hey, I got a puzzle for you. Are you ready for it? You got your thinking cap on? Let's get this done. If you got a $700 a month rental, you're getting $700 in each month. How much of that actually goes into your pocket each month? I just had an owner who got crazy mad at me. She told me, how dare I question her numbers? She told me about $700 rent. She got $630 in her pocket. She was putting $630 towards a Maserati. I'm telling you what, how dare I question her? All right, let's run the numbers. I'll tell you how much she's really putting in her pocket each month. Let's go. All right, we're back. Let's figure this out. $700 a month. How much are you going to get in your pocket? It ain't no dang $630. These numbers are not sexy, folks. This is not attractive stuff, but if you want to make money in real estate to be able to spend $630 towards a Maserati payment or whatever you want to spend it on, you need to know your numbers up front. And I can tell you right now, it ain't no $630. All right, let's talk this. All right, so here's our rental. This young lady had this rental. She's getting $700 a month, right? Now, there is certain things that are not sexy, but you need to know. There are certain things that's going to cost you every month that you need to plan for just in case. And most of the time, you're going to use these numbers. So anyways, all right, look, vacancy credit loss. Every time a tenant moves out and you got to get ready for the next tenant, or the time frame between one tenant moving out and the next tenant coming in, you got to figure that that's going to be rent lost, right? So if it takes you a month to get another tenant in, you're going to have, it's going to be about 8% of your yearly income is going towards that vacancy loss, right? So you're going to miss 1 month of this. So average repairs, and I don't care who you are, you're going to have repairs throughout the year. And if you don't, you're lucky, and the next year you're probably going to get it from the previous year. You know what I'm saying? So I always try and figure in 10% of my gross rents towards repairs, annual repairs. That's not a lot. $700 rent, that's $840 a year that we're putting towards repairs. I got a plumbing leak. I need you to come out and fix it. Oh, there goes $150. Oh, I got a toilet that's whatever. I need you to come out and fix it. Oh, there goes another whatever, $100. I mean, this stuff is not, it's just, it adds up. So you got to factor in average repairs. You're also going to have to factor in, you're going to have to replace the roof after so long. You're going to have to replace, redo the kitchen. You might have to repaint the property. One tenant moves out and God forbid they don't have any money, so you're stuck holding the bill. So you got to factor this stuff in. So I always try and factor 10%. Now, excuse me, if you got higher rents, then you can keep these numbers lower. But you need to figure out a good number of how much money you want to put towards your rents. If you're dealing with low income, I'm going to figure 10%. That's what I would figure. So you got 10% towards average repairs. $820 a year you're going to put towards repairs. Maybe you'll use it, maybe you won't. Hopefully you don't. You're going to have accounting and legal. Now this number will change depending on whether you're using a tax guy or not, or you're using an accountant or whatever. And if you got multiple properties, then that number may change or whatever. And then finally, we've got property management. Now I'm going to cut you in on a big secret here, folks. Most property managers charge 10% of each month's rent towards property management. They handle the phone calls. They deal with all the stuff that you don't want to deal with. That costs 10% a month. Now, what happens, like in Indiana, most of the good property managers are charging first month's rent to find and place a tenant, and 10% of each gross month's rent. So then you're talking, that first year, you're talking 18 to 20%. So, I keep it low, 10%, because that's what it's going to cost you, but you may have more than that. So you need to factor that in. All right, so basically the total operating costs here are 31%. So, let's do a short sheet. Let's say it's cost you about 30% a year for having to replace a tenant, which may or may not happen. My average tenant stays 4+ years, but sometimes it takes 2 or 3 tenants before I find that tenant's going to stay 4 or 5 years. So that's the reason I always figure in 1 month a year where I got a vacancy. So you got vacancy, you got average repairs, you got accounting and legal. You might have advertising if you're doing it yourself. If you're doing property management yourself, I still figure, even though I got a property management company, I still figure 10% for property management because I got to pay myself to deal with this crap. So you factor in the 10%, right? So that's about 30%. So 30% of that, plus you got to add in your taxes, and you got to figure in your property insurance. So taxes on this property are cheap, $820 a year. That's cheap. Should be more like $1,200 a year, so about $100 a month. Normally when I'm running numbers in my head, I'm on a property, I'm figuring $100 a month for taxes. So we got $820 for taxes here, and then property insurance. Property insurance is between $550 and $600 per year. So that's about $50 a month, right? So these are all numbers. So when we figure in these assumptions here, and we figure in our property taxes and our insurance. Now, if you have other stuff, like you got to pay trash, or you got to pay electricity or gas or oil or water, let me clue you in. In Indianapolis, most multifams, 2-bed or 2 units or more, the owner pays water. So you got to factor that stuff in. So if you got trash or supplies or electricity, anything else, you got to factor that stuff in. How much it's going to cost you a year? You got to run those numbers. But we're not running this because this is a single family. So look here. Her total operating costs are $331 a month per month. So what happened to her $700 minus her 10% property management, which made $630? She just lost $300, an extra $270 or so. So now her $630 turned into $368.83. I'm getting $630 every month. You don't know what you're talking about. I do know what I'm talking about. You're actually got about $368 in your pocket each month. Now, what if you have a loan on the property? Oh, everybody talks about, go out and get leverage. Leverage. BRRRR, the BRRR. Buy it, rehab it, rent it, and then refinance it and repeat, right? So let's say it's a $45,000 purchase. She's got 70% loan, 30% down. So she's putting, $13,500 down. So she put $13,500 down, and then she's got 70% finance, 20 years at 6% interest. So her mortgage payment is $225.68, right? You follow me? So that means that her cash flow is actually only $143.15. So she's making about $150 a month off this property, cash flow. So what happens if she has a $4,000? She has a $4,000 sewer job she has to do. 4,000 divided by 150. She got 27 months of no money coming into her pocket before she breaks even on that sewer job, right? I mean, painting a house probably cost you $1,000, $1,500. I mean, how much is that? Let's run that number. Give me a second here. Let's say it's $1,000 divided by 143.15. She's got 7 months. If she has to repaint the interior of the house, 7 months of her cash flow is going towards that. Follow me on this? So all right, so 45,000. So she's got this cash flow 143.15, right? Oh, but depreciation is going to save me. Lord Jesus, I'm going to be saved by depreciation that I can deduct on my taxes every year. Yeah, look at this, 27 and a half years. She got $39,000 in the depreciation, because you got to figure depreciation is purchase price minus your assessed land value. Her assessed land value is $5,800. So this property, it's 27 and a half years. So her annual depreciation would be $1,425.45, but she's in the 10% or 25% tax bracket, so she's $350. So her yearly tax savings is $356. So that's $29.70 a month. So that brings her up to $172.85. Oh wait, let's go back to our numbers. Oh, I got to do it again. Calc. 15. Well, what did we say? 1250 divided by 172.85. That's almost 8 months. What were we at before? I don't even remember. About the same, weren't we? Yep. So, these are not holy grails here. So, but let's look at return. Is this a good investment for her? $700 a month. She paid $45,000 for it. If the numbers are all running right, look, it's about almost a 10% return. Cash. If she paid $45,000 for the house, she's getting about 10%, 9.84% return on her investment. Right now, because she's got a loan on it, she's actually getting like 12.72% return on it. You follow me there? Cash on cash return, 12.72%. So is that a good investment? 9.84%. Heck yeah, I'll take that all day, every day. 12.72 if she got a loan on it, every day. So yes, it's a good investment, but she's not making $630 like she thought. She's making $172.85. It ain't rocket science, folks, but you do need to know your numbers. All right, folks, here we are. That's how a $700 a month rent payment becomes $173 a month. It ain't no $630 a month going towards that Maserati. It's $173. Still better than zero going towards that Maserati payment, but it's going to take a little bit more investing to get up to that Maserati payment. Anyways, I'm Lee Smith. Click the subscribe button, click the bell so you get notified the second I have new videos. Going to do two a week, so we can get you educated on how to do rentals. And if you got a property to sell me, man, my phone number's been on this thing the whole time. Give me a call. Let's get it done. Lee Smith, Spouse Buying Houses. Thanks for your time, guys.